Moving on to chapter 7, the final chapter in the first section of this class. Now we are carrying our discussion about internal control forward. As we discussed, since the 1990s, the audits have been risk-based audits where internal control plays a major role to ensure that a weak internal control does not increase audit risk. Okay, what is audit risk? The risk that the opinion, while is actually not unmodified, ends up being reported as unmodified because we were not able to detect or because the internal control was weak. AR equals IR times CR times DR. That's why a strong internal control is the most important factor in any audit. Okay, so what is an internal control? A process designed to provide reasonable assurance that operations are working effectively and efficiently. When can they work effectively and efficiently? Of course, they can work effectively and efficiently, when management has a proper grip over the business, they are following proper procedures, employees are educated in the field of accounting, okay, and there is a tone from the top about doing the right thing, okay, which we will look further into this chapter as we get further into this chapter. The reporting is reliable. When is it reliable? Of course, the things that I mentioned to you make the reporting reliable as well. And then you have compliance. Okay, and all this happens when management says we will do the right thing. Means hire the right people, okay, make sure do the right kind of reporting, and make sure that all the laws are complied with and followed. And that is what gives you a strong internal control. Of course, we need to take into account the cost-benefit analysis as well. If I am running a very small business and I cannot hire 5 people to just make sure that there are checks and balances and internal control is being followed. In that case, I would have to substitute that by myself being strongly involved in the day-to-day activities of the business. And that's one question that you may get on a multiple choice to, make sure that everything goes through the cost-benefit analysis test in a small business. You can offset those segregation of duties and those kind of internal controls by making sure that the owner is fully involved in the day-to-day activities. Okay, so that way you don't have to hire many people. And of course, this is again a matter of opinion. Okay, but numbers don't lie and money does not lie. An important section of the internal control is your FCPA, Foreign Corrupt Practices Act of 1977. Briefly, let me explain this. As you may recall from history, in 1977, Jimmy Carter took office, and the environment in the country after Watergate was that we need to aspire to a higher degree of integrity. Okay, and that also reflected in the government's tone in businesses, and they came up with the Foreign Corrupt Practices Act, where they say that you cannot bribe foreign officials. Okay, all foreign transactions have to be disclosed. For example, in foreign countries, there was one country that I was auditing. They started putting down for foreign financial transactions a transaction called fast money. What they meant by fast money was greasing the bureaucrats to make sure that the business is done properly. Okay, of course, they said that this is supposed to be a practice in this country and everybody does it, but it was in violation of FCPA. It had to be fully disclosed, okay, and management had to stop the practice, otherwise the auditing firm was not going to give them a right report. It was a small business, but they had to do that because all transactions executed with knowledge of management, they are recorded, and access to assets is limited to authorized individuals, checks and balances. Okay, so Foreign Corrupt Practices Act, while it's not heavily tested in the exam, is something you need to know because we are living in a global economy, and this act and the implications of that are important. Okay, now controls are three kinds of controls: meant to prevent wrongdoing, preventive; to detect wrongdoing, detective; meant to correct wrongdoing, corrective. Okay, they can run together. Segregation of duties is preventive. Someone who has control over cash should not have control over recording function. Reconciling, looking for mistakes, detective; making adjustments to correct the mistakes is corrective measures. If this is strong, this too will not require that much work. Okay, hopefully. So, three kinds of controls that we need to know, and a good org chart for checks and balances is important. So let's take a quick look at this org chart. Now, look at this. The treasurer or vice president of finance, custodian of assets, in charge of cash, custodian of assets. Look at this controller. The record keeping function, forecasting and budgeting, tax planning and returns, accounting, okay, general accounting, ledger, payroll, record keeping function. Okay, pay close attention to this part. Record keeping function. Now think about this. If this person was in charge of this, what could go wrong? Vice president of sales in charge of this, what could go wrong? I need to meet my budget numbers. I'm going to manipulate and arm twist this guy into making sure my numbers are met on the books. Okay? This person has no record keeping function, because think about this. If this function of accounting was under the treasurer, what does that mean? I am the custodian of cash and I'm the record keeping. I can steal the cash and I can adjust it somehow on the books. That's why segregation of duties is very important. Okay, and we will see a lot of questions on this in this particular chapter. 5 components make the internal control. What are those 5 components? Control environment, the process to assess risk, information system, control activities, and monitoring of controls. We'll look at each and every one step by step. Okay? Now, control environment. What does that mean? The environment under which you are working, the tone at the top. Management says we are committed to competent people. We are committed to doing the right thing. Okay? We have a mission statement that clearly states that we will function in an environment that is honest. Communication is open. We have an open door policy. We will do the right thing. We will not try to pressure our employees into doing the wrong thing. And we will hire the best possible employees from the market. Okay? Now, what I have just told you are all is right. I mean, it's a lot of noise. And Enron management also believed in all these things. Whether they believed or they actually said it is different. It's one thing to say it and one thing to comply with that. And so a management that complies with it has a strong control environment, and a management that does not comply with it and has no commitment to it means a weak control environment. In a weak control environment, there is a higher chance of things going wrong. Okay, so that's what you need to know. So that's the control environment. Okay. Of course, a part of that is also the org chart that I explained to you. These 3 functions have to be separate. Okay, and we talked about that when we said that the record keeping and the custodian function and the record keeping should be separate. Custodian is the treasurer. Record keeping is the controller. What I am showing actually as assets versus what is on record has to be reconciled by an independent party, usually the internal auditing department. Okay, and as outside auditors, we also need to do some of it, but an internal auditor looks at it in much more detail. What I actually have versus what I'm showing on my books has to be reconciled. HR policies and practices. Okay, let's talk about that. we have in a way talked about it or I have at least mentioned it in the previous lectures when I have said hiring the right people for the right jobs. There's no entitlement, right? If you have the skills and the qualifications, you get hired. If you don't, you don't. Okay? If you don't have the skills, does that mean that you should not get a job? In many cases, yes. But if you look at it in a positive way, you can get the job if you go out and get the skills. Think about the time you are spending in this class, the work that you are doing. Why is that? Because someday some HR that believes in doing, and I would say many HRs that believe in doing the right things are going to hire you because you have the right skills. And as I said, you are in the right profession, okay, and you're going to be getting good jobs. At least from my experience, I'm telling you, and from a lot of my friends' experience, okay? But for that, you need to get the right skills so you can get hired for the right job. And then, of course, when you get hired for the right job, you're also going to bring in the right kind of people, because that is going to strengthen the control environment. That is going to strengthen the internal control. Okay, so that is your control environment. Management and the way of doing things, over aggressive, under aggressive, is all a part of that control environment, and you need to understand that clearly. Okay, the next step is, or the next component is your risk assessment. Let's read this real quick. Any of these things will increase the risk, okay? And so in your risk assessment, new regulations means new taxes, new compliance, new duties for global companies. Going concern problems can happen, like in a sensitive industry like the tobacco industry. Changes in personnel, very important, okay? Very important. The CFO has changed. The controller has changed. The new controller has come in. The new controller may not know what, it may take that person some time to get their feet wet. They may not know what to do, okay? Increases the risk. New information system. Even, very important. I remember when I was in college, I used to be a bank teller. Even at that level, getting a new information system meant that I used to see many tellers who would balance their drawers instantly would have problems when a new system was put in place because they didn't know how to use the system. Increases the risk, even at that low level, okay? An organization that grows rapidly is more or less concerned about sales and does not pay much attention to costs and the policies and procedures. That's just a natural way of doing things. And that's when you need, as an auditor, need to come in and tell them the right things that they need to do. Okay? Introduction of new lines of business, products, or processes increases the risk. So when you assess the risk, any of these things may increase or sometimes decrease. A new product means more business. More business means less pressure. More revenue means less pressure to meet, the basic objectives. It may decrease risk, but you may not know it until you do a proper assessment. Accounting information system. Have you heard about companies that start using with QuickBooks and then eventually they grow out of QuickBooks? Well, why is that? Because QuickBooks is not sufficient for them to do all these functions. Recording, well, it may be sufficient for recording transactions, but they have manufacturing and now they need a bigger system to take into account the bigger volume. They need a good system in place, and I'm talking about IT systems right now. But besides IT systems, they also need proper standard operating procedures, proper ledgers, proper journals, proper record-keeping devices. So if something goes wrong, there's always backup to refer to. These devices combined should provide clear guidance to employees about their individual roles and where do they fit in the large picture. Okay, proper accounting information system means good IT systems, good manuals, good policies. Ever worked at a place where you started a job and there was nothing to refer to and you got frustrated? Ask yourself. It's very likely you may have if you have had significant work experience, and that happens. But an accountant, a CPA, is also a good manager. Okay, a marketing person cannot do your job, but you can do a marketing person's job, because being a CPA means you know how to strategize, you know how to organize, you are trained for that. You're not just trained with numbers, you're trained with all these things, and once you have that, you will know the importance of this. Okay, so those things also you need to keep in mind. These devices should provide clear guidance to employees about their individual roles. When you set clear expectations, you have happy employees. Okay, when you have happy employees, you have what I call a better work product. Employees, better trained employees stay longer. That longevity will help you gain more out of those employees. Clear set of expectations always helps. Okay, and that would be a part of communication in the AIS system. So that's the third component, control activities. All right, let's review this and let's talk about this. Okay, are there budgets? Do employees get a performance review? Is the information processed with the best kind of systems? When you sign in, do you get passwords? Okay, are the warehouses locked? Is there proper security access to the vaults? And this thing, segregation of duties and authorization, is that being done in the right way? These things are important. Again, anytime you see a question about serial numbers, you know it is referring to the completeness assertion. Are proper serial numbers being used and tracked for documents like checks, sales orders, and purchase orders to maintain proper track? Okay, that is very important, right? So physical controls like restricting access to specific individuals, these things will come into play, and it will only strengthen the internal control. Okay, so control activities is the fourth component of this. And then you have a realization and an acceptance. What is that acceptance? That the best internal control has its own limitations. Okay, not properly trained, errors may happen. Okay, my boss comes in all the time and says, let me sign onto your computer. Think about this. You go to a cash register at a grocery store. Only one person who starts the day is supposed to use that. You may see during rush, people will just come in and start ringing. Why? Because they don't understand that they cannot do it. That's management override, circumventing the system. Compliance may deteriorate over time. Okay? One part of circumventing is also when two people collude. What is colluding? The payroll department manager is your friend. He says, whenever I receive your payroll, instead of doing it for 35 hours, I will give you 5 hours of overtime every week, or instead of doing 40 hours, I'll give you 5 hours of overtime, and then we'll go half and half. That's colluding. There was separation of duties, but it was circumvented because of collusion. Okay? As I told you, a lot of these controls can be substituted if the owner is knowledgeable and maintains proper control. Now, let's take a quick look at what kind of tools are at your disposal. Let's review this real quick. All right, we discussed this in Chapter 6, the steps, and we said we are focused on these two steps right now. And how do we assess these two? Getting a control. You have flowcharts, you have narratives, you have questionnaires. And as you follow that checklist, you will gain an understanding of this. The combination of three, we'll look at flowcharts later, but written narratives and questionnaires, the combination of three would help in concluding whether the controls have actually been implemented. Okay, let's take a look at this. I'm going to give you one example. Are all persons receiving or dispersing cash bonded? This says yes. So what's the reason behind why we need this to happen? Think about it. A person who is bonded knows that if I steal and run away, the company is going to recover the cash. But an insurance company that specializes in going after people like me is going to be after me, and the chances that they will let go is really low. Okay, a deterrent to theft strengthens internal control. Okay, now here's a weakness. Is that a major weakness if it's a no, or a minor weakness? If it's a major, then your remarks. Okay, see mitigating control in number 13. This is not happening. It's a minor weakness because we are in a way taking care of this step in number 13. What you should do is take a few minutes and read this and then ask yourself the questions. If it may not be applicable. Okay, if I'm doing cash, this may not be applicable. But some that may be applicable, by putting yes, how does it strengthen the internal control or does it weaken the internal control? Without delay. If you deposit it without delay, there is less chance of a theft. Okay, other than accounts receivable bookkeeper. So you got to take a look at all these things. When you read this step by step, you will understand why you need good internal control. Okay, now once you look at the internal control, you can find out what are the risks of material misstatement. If a financial assertion can go wrong, the risk is big enough to result in a misstatement. Okay? Non-routine transactions have a higher risk of control than routine transactions because it requires judgment, management estimation, and these things are subject to bias and the risk increases. Okay? Once you have reviewed all the internal control, the next step is a report to management that has your recommendations for correcting any deficiencies. And here is that report. These are the things that you have found and the suggestions. Who is the report addressed to? Board of Directors. By who? By you. Okay? And it tells you very clearly. Let's read this real quick. First, you're telling them that we cannot disclose all deficiencies, but whatever we found, we are telling you. And these deficiencies are big enough that they constitute a material weakness. And a material weakness means a weakness where a financial assertion can go wrong. Okay? Addressed to Board of Directors, written by you, the CPA. Okay? That's your management letter. Biggest advantage of that is it can help limit your liability. When you go to the court, it's all about, did you do your due diligence? When you have this, you have done your due diligence. And that concludes our discussion for Chapter 7 and the first section. Okay, we have learned about internal control and what can go wrong. In the second section, we're actually going to see, when we do an audit, how to apply those principles. Thank you, and we will be discussing Chapter 10 soon.